Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. You can check us out on YouTube as well. Just go to youtube.com. One story that broke a couple hours ago is Amazon canceling orders for multiple products made in China and other Asian countries, thinking things like beach chairs, scooters, air conditioners, and things like that. Joining us now is the reporter who broke that story. Spencer Soper is Bloomberg News technology and e-commerce reporter. How does all of this work for Amazon? So they place orders how many months in advance, and then what's the ripple effect here?
That's a great question, and a lot of this stuff, they kind of have like a target of how much they'll need, and then they'll place orders maybe monthly or that sort of thing. And so these cancellations affect what are called direct import orders. This is where Amazon tells vendors, hey, look, you're making this stuff in China or some other country in Asia. We can actually transport it to the U.S. cheaper than you can because we do so much volume. Why don't you let us just buy it from you in the source country? We'll import it, we'll pay the tariffs and pass those savings on to customers. That makes a lot of sense previously, but now with tariffs in the mix, it gives Amazon a lot of exposure to tariffs, and that's why they've abruptly canceled a bunch of these types of orders.
All right, so Amazon cancels the order. Presumably the vendors left with, in your story, 500,000 beach chairs. What does that vendor do?
You scramble. So a lot of this can basically just reset negotiations. I mean, first, let's say a lot of these purchase orders should be binding, but these folks don't want to get tied up in court with Amazon. So Amazon is kind of flexing its muscle a little bit here. And then, they can renegotiate with Amazon on different terms to still sell them through Amazon, but obviously share some of the pain of these tariffs. And then other options are going to other marketplaces. And this is an opportunity for folks like TikTok Shop, Walmart, Temu to stand out as alternatives. So they do have some options, but Amazon's still like the main show in town when it comes to U.S. online sales.
Was this move unusual or expected?
Very unusual and definitely unexpected. Most of these folks said they were, completely caught off guard by it. Like I said, the beach chair vendor has been selling for more than a decade on Amazon and actually had the stuff made. So it's not like they said, hey, this order way out, let's cancel that. This is stuff that he's already, had a factory make and is on the hook to pay for. So with no communication or real explanation. So this is definitely showing how these tariffs are basically disrupting a lot of relationships and forcing partners to negotiate with one another.
Have we heard anything from Walmart about kind of how they plan to navigate these tariffs?
I haven't spoken specifically to Walmart, but a lot of these companies are just in the same game. You figure Walmart has an advantage of selling predominantly grocery, and so if there is a pullback, people still need groceries, so they'll still do well there. But then, in terms of like these large diversified retailers like Amazon and Walmart, you're just likely to see a shift in the mix of products, like more consumables, more everyday needs that people need in their daily lives, and less of this kind of discretionary stuff like the beach chairs we mentioned or scooters or that kind of thing.
How many more levers like this can Amazon pull?
Amazon has many levers and knobs, but so do its partners, right? So this is kind of a gamble. So if Amazon's pulling back on its orders, then that the knock-on effect of that is some of these folks that sell on Amazon and rely on Amazon for sales might have to pull back on ad spend. So Amazon can turn one knob, but then someone else turns another. It's like popcorn popping in a kettle.
What have we heard, Spencer, from some of the Chinese players like Alibaba, like Temu? How are they planning on navigating the new environment?
I haven't heard much from Alibaba, and then on Temu has basically been kind of anticipating a lot of this. A bigger issue for them was this de minimis loophole, and they've been kind of forward deploying more inventory into the U.S. So that was another thing, is folks just trying to get ahead of this and get inventory into the U.S. before these tariffs take effect. And then another option for folks like Temu or Amazon or any vendor selling anything is just looking for countries not affected by these tariffs. And so that this is making places like Canada, Australia, other markets much more desirable, especially if you've got to unload inventory and want to avoid these tariffs.
Does any of this yet? Did you have a sense, just in your reporting, how demand is holding up at all? Like we talked a lot about the supplier side, et cetera, but are we seeing sort of stockpiling ahead of the tariffs in terms of consumer behavior?
That's the $1 million question right now, and there's definitely a lot of cross currents, and that's the fear, right? Is like a lot of companies, analysts, everything, they can get real-time data from sources that track like credit card transactions and stuff, and so that's a big concern right now. Is there like almost like a false flag that the consumer's safe if in reality they are just like stockpiling on things, getting ahead of the tariffs, and then demand's going to drop off a cliff in several weeks. So that's something that people are actively monitoring and scratching their heads about right now.
All right, Spencer, thank you so much. We appreciate that. Spencer Soper, Bloomberg News technology and e-commerce reporter.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Let's take a broader look now at the relationship of U.S. and China. It's not good. What's the off-ramp at this point? Joining us now is Leland Miller. He is a CEO of the China Beige Book. Leland, you are deep into the China economy, China-U.S. trade relations, etc. What levers does China have to pull to help support its economy in the middle of a trade war?
Well, markets have been expecting there to be some sort of giant stimulus response for years, and they were always disappointed because it wasn't in Xi Jinping's interest to sort of rejuice the economy after they've gone through maybe not deleveraging, but certainly a tightening of credit to areas of the economy outside of their priorities, like advanced manufacturing, et cetera. We're entering a very new era here. And so depending on how severe geopolitics and the trade wars get going forward, they're going to start looking at these levers more seriously. Obviously, one of the big one is fiscal spending. They don't want to do a bazooka like 2008, and they've already done a lot of monetary easing over the course of the past couple of years, so there's not that much oomph there. But there is spending they can certainly do. And in our latest data, we have actually seen our proxy for infrastructure, infrastructure spending start expanding and go up. Transportation construction, firms are borrowing more, they're investing more, they're hiring more. So they are readying the ammo gun in case they need to use it. But I think they're trying to figure out whether this is going to be a short-term problem or whether this is the new norm.
So, Leland, nobody knows this better than you, but where is the capacity for China and the willingness for China to really go toe-to-toe with President Trump in the U.S. on these tariffs? What is their capacity there, do you think?
Well, their capacity and their willingness are two different things. I think their willingness is very high. I think we're already seeing there was a signaling before it happened, and then now that it's happened, you see there was the message was always, if you do something to us, we're gonna respond. You do something else to us again, we're gonna respond. Now the problem here is that China doesn't have the capacity to go one-on-one in the trade field with the United States, simply because the United States is a massive importer and China is a very weak importer by comparison. So if you're just talking about trade, the U.S. has much more leverage and can put much more pain on China. This is why once you get to a certain point, and to the extent that Beijing is willing to risk an escalation, you're going to see things expand outside the purely trade realm. It's not going to be just a conversation about tariffs. Already we're moving outside of it, but you can expand it more dramatically to other areas and even punishing U.S. firms on the ground in China.
I mean, yeah, we already heard the headline that China's, telling students that want to study in the U.S., like, think twice, for example, before you do that. In terms of levers it can pull, I know you mentioned helping domestic capacity and sort of pumping money into the system for consumers might not be the best. But in terms of the Yuan devaluation, for example, how orderly can China keep that?
I think they can keep it pretty orderly because they want to keep it orderly. It seems like every time there's any kind of geopolitical tension between the U.S. and China, any trade tension, there's anything going on in terms of just a weak Chinese economy, there's people screaming to the sky, the yuan, devalue it, devalue it. They really don't want to do this. It's not that it's not a tool in the box to use, but it's for break the glass emergencies. It doesn't mean they're not going to blow off steam against the USD. It doesn't mean they're not going to have a signaling purpose from moving it incrementally. But they really don't want to do one of these one-off devaluations. It would be a massive escalation. It would be seen very poorly, not just the United States and around the world, but you're also sitting in a situation where you're going to create a lot of stress inside the Chinese economy. You're going to put pressure on having more capital outflows. You're trying to increase consumption. By weakening the yuan, you're going to hurt consumption even further. So this is not just some piece of trade artillery that they can use willy-nilly. To go there in a big way, they need to really have a substantial escalation.
Hey, Leland, does China view this U.S. nationalism from President Trump administration, from a global trade, from a global military, political, as a real opportunity to expand its influence? Do they view this as a once-in-a-lifetime opportunity to do that?
I think there's a lot of voices in China. I think that they don't like some of what's happening. I think other things they see as an opportunity. Certainly, if U.S. allies and partner relationships are breaking down either in the region or around the world, they'd love to take advantage of that. And not necessarily by replacing the U.S., by simply saying, stop helping the U.S., stop buying into what they're doing. So there are opportunities in here if it's played wrong by the U.S. government. But I think that we're in such a dramatic place differently from where we were a few months ago. They're trying to digest this just like the rest of us.
Will this move China to make connections and trade deals and more economic ties with the rest of the world? And is the rest of the world open to that?
China would love lots of trade deals, but China wants them on their terms. And what they want to be able to do is not import on other countries' exports, and they want to just shove their exports down everybody else's throat. So to the extent that they can strong-arm countries or there's unique advantages to having some sort of bilateral relationship, then maybe these proceed. But keep in mind, to the extent the U.S. shuts itself off from Chinese goods, it's we import a lot of Chinese goods and have for a long, long time, then they're going to have to send these goods somewhere else. So in addition to all the overcapacity problems you have simply a need to replace the demand for Chinese exports elsewhere. They're going to be flooding Southeast Asia. They're going to be flooding Europe. They're going to be flooding South America. So this is going to have to demand a policy response from all these other countries. And the question is, do you really want to do a trade deal with the Chinese if you're not getting anything back in return?
Leland Miller, thank you so much. We appreciate your time as always. One of our go-to voices on all things China economy. Leland Miller, CEO at the China Beige Book. One of the things we like about chatting with Leland is at the Beige Book, they have really unique data. They have boots on the ground. They don't rely upon the government data because that historically has been not quite reliable. So again, they have their own data sets there that they rely upon to give them a sense of where the Chinese economy is. We find out from Leland that he's usually ahead of this stuff. So appreciate getting his time.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us in studio. How about that? Kristina Hooper, Chief Global Markets Strategist at Invesco. We usually do the Zoom thing, but we've got her in our studio here in New York. That's great. Kristina, you've got perspective. You've been around. This isn't your first rodeo. What do you make of the last 3, 4, 5, 6 trading days?
Well, this is an environment in which there is just a super high level of uncertainty, and that is causing all kinds of wild swings in all different corners of the market. And I think this is not that dissimilar to what we saw in the early days of COVID. That was a time when there was just an incredible amount of uncertainty, and markets reacted with an enormous amount of fear, wild swings. And the other similarity is that it's all about policy, that the outcome of this crisis will be dictated by policy. Mm-hmm. And so in some ways that's helpful because you can You can do a scenario map and ask yourself, if X happens, we think Y will happen. But it is a very, very unusual environment, just punctuated by just an incredibly high level of uncertainty.
Speaking of that, Amazon canceling orders that affect multiple products and vendors after China tariffs. They're citing trade disputes as risk factor, and this coming out in the annual report. The difference in obviously is that this is a self-inflicted policy. This is not what happened in COVID and we shut down and then we had to help. To go specifically to the Treasury market, are you seeing, are you hearing, are you worried about the Treasury market not functioning properly like we saw back in 2020?
So I certainly think that's a concern. Right now, I don't think we're seeing that, but we do know that our trading partners know some of our big vulnerabilities, right? And one of them is that we spend an awful lot servicing our debt. And so one way to punish us would be to sell U.S. Treasuries. So I certainly think we are aware of the vulnerabilities and we should be following it closely.
At Invesco, what is your, economic forecast? Do you have a recession in your forecast?
My base case is that if we see tariffs remain at these relatively high levels, we're more than 50% probability of going into a recession this year. Doesn't mean that it's going to be a deep recession, but I think that certainly the odds are in favor of recession if we see tariffs remain at relatively high levels. But if we were to see a de-escalation, we could easily see a risk-on environment with U.S. assets benefiting. So it is very much in the hands of policymakers.
And then to that point, you just look at Delta, right? Pulling guidance. If a company pulls guidance, you would assume that the stock would sell off, and that would be really bad news, and the stock is up. It's sort of like it's not going to take much to maybe move the needle. Where is safety, though, now, as you wait?
So safety clearly is in gold, and that's what many investors are articulating through their purchases. But there is also safety, of course, in Japanese yen, in the Swiss franc, some of the traditional safe haven asset classes ex-US. I don't know if there's as much safety in treasuries or the USD.
Wow. That's a statement. International rest of world stock markets been outperforming the U.S. pretty well, and that doesn't happen very often. Is that a trade? Is that a longer-term trend, do you think? Are international markets maybe more attractive from an equity perspective?
Well, certainly from a valuation perspective, and for some markets from a dividend yield perspective, they are more attractive. And you have to recognize a very significant catalyst, which is the potential for fiscal stimulus, material fiscal stimulus coming from Europe and from China. And I think that can be a countervailing force to the headwinds that come from these tariff wars.
Countervailing force, could that also come in the U.S. in the form of tax cuts? Would that be enough?
That's a good question. I'd have to see exactly what those tax cuts look like, because keep in mind that it's lower income households that are going to be hit the hardest by these tariff wars. Of course, all consumers will be hit to the extent that the wealth effect is impacted, but I think lower income households, the burden is higher for tariffs. So what will the tax cuts look like, and will it benefit lower income households? So when I know that, then I can answer that question.
Another headline: China issues warning for students studying in the U.S. So there you go. Ripple effect, I guess you call it.
Yeah.
Fixed income. What's the play here, Kristina, in fixed income for you guys?
So I think there's certainly potential in a number of areas. Again, a lot of it has to do with one's time horizon. But certainly floating rate, I don't see the Fed cutting rates anytime soon. I know 4 cuts are priced in. It's hard to believe that's going to happen in this environment where we're seeing market-based inflation expectations go up and where we're seeing consumer-based inflation expectations go up.
Aside from, I guess, from where you sit, what would certainty look like? Because to some extent, we know what stuff is. Like, we know what tariffs are. We know that. We don't know necessarily what all the response will be. So what would it take for you, as someone who's been in the market for a long time, to feel confident?
So I hearken back to the first Trump administration.
Definitely hearken.
And how that played out. 2018 was a really difficult year. The S&P 500 was down. We saw some foreign markets down much more. But just a modest alleviation in tariffs helped and gave markets confidence. So something like that, I think, is enough in this environment. There's really a bias towards optimism, especially in the equity market. So there's hope. Even if we were to get some kind of reduction, some deals negotiated with some countries, I think that could be helpful. That doesn't give us the extreme certainty that I think we crave, but it's enough.
Kristina, thank you so much. We really appreciate it. Kristina Hooper, Chief Global Market Strategist for Invesco, joining us live here in our Bloomberg Interactive Broker Studio, which is a good thing.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.